Bitcoin is trading around $110,900 today, slipping a little over 1.5%. The intraday high reached around 113,200, while the low stayed just above 110,800. Ethereum is holding at about $4,288, also down a bit under 2% from the previous close. Even with this pullback, both assets remain solid. Bitcoin is up over 1.5% this week. Meanwhile, Ethereum shows long-term strength, which keeps attracting investors. Market analysts say Bitcoin's resilience comes from a few key factors. First, there are expectations of U.S. interest rate cuts. Then, fresh liquidity is flowing in, especially via stablecoins. Also, institutional players are feeling more confident. Ethereum, on the other hand, has been surging throughout the past few months. Since May, it has risen nearly 25%, hitting almost $5,000 at one point. Some bull forecasts now suggest Ethereum might reach between $10,000 and $12,000 by year's end. This optimism stems from several factors: institutional investment, new ETF approvals in the US and Australia, and Ethereum's key role in decentralized finance and Web3. Now let's talk altcoins. One name to watch is Remittix, or RTX. This project is in pre-sale, priced just above 10 cents. It has raised over $23 million and sold more than 640 million tokens. The upcoming mobile wallet is getting a lot of attention. It will support over 40 cryptocurrencies and 30 fiat currencies. This makes it a strong competitor in the remittance market. The team has also announced listings on Bitmart and L-Bank, plus a $250,000 giveaway to early supporters. Compared to that momentum, established coins like Cardano, Kwon, and Polygon show weaker volume and slower growth. So, analysts are tipping Remittix as one to watch. Institutional moves are also shaping the landscape. Hong Kong's leading crypto exchange Hashkey has just launched a $500 million digital asset treasury fund. The fund will start with Bitcoin and Ethereum, but aims to support Web3 infrastructure projects worldwide. This is a clear signal that institutional adoption isn't slowing down, it's accelerating. On the legal and political front, Kwon, the founder behind Terra and Luna, has pleaded guilty to fraud in New York. His fall in 2022 caused trillions in market losses. Now he could spend up to 12 years in prison and must forfeit $19 million. This case is a major wake-up call for the crypto industry. It shows how regulators are cracking down on wrongdoers. Meanwhile, the Trump family is once again making headlines in the crypto space. Eric Trump and Donald Trump Jr. have watched their stake in American Bitcoin rise to over $1.5 billion after the company debuted on Nasdaq. At one point, their holdings were valued at over $2.5 billion. The company now owns over 2,400 Bitcoins. It plans to raise more than $2 billion to grow its Bitcoin mining and accumulation efforts. Critics are concerned about conflicts of interest. However, the Trump family insists their business and politics are separate. Across the Atlantic, the UK is quietly pushing forward in the crypto space. Earlier this year, Kraken got the green light from the Financial Conduct Authority. This approval allows them to provide electronic money services. It helps tackle the debanking issue that many crypto businesses encounter. IG Group recently became the first UK-listed company to offer direct retail trading for many cryptocurrencies on its Uphold platform. While custody of assets is not covered by compensation schemes, this still marks a huge step for retail investors in Britain. Bitcoin holds steady between $110,000 and $112,000. Ethereum is gaining bullish momentum and consolidating. Remittix is becoming a hot new altcoin. Institutional activity is growing from Hong Kong to Wall Street, boosting the market. Politics and regulation always come up. The Trump family's crypto empire is expanding, and Kwon's guilty plea brings back old wounds. That's the roundup for today. If you want to stay ahead of the curve, make sure to hit like, subscribe, and turn on notifications so you never miss an update. Thanks for tuning in, and we'll see you in the next one.